All right, guys. I want to talk about the importance of time frames. All right. A lot of you guys probably don't even look at many time frames. You guys stuck on the 1 minute, the 15 minute, the 4 hour as your high time frame, and you guys have this consistency of losing a lot. All right. So I do want to stress that the higher the time frame, the more stronger the magnets are. All right. Which may sound confusing, which I'll explain later. When you understand the higher time frame, you understand how the lower time frame should look like in order for price to reach there. All right. So it's very, very interesting when you start looking at price like that. Here, through this whole move down here, my students and myself, right, I've been telling them this low has a very, very high chance of being taken out, right? And again, it's not nothing major, right? I'm sure, when price is displacing that quickly, you can have, a bias of this low being taken out. But why did I expect this low to cause some sort of reaction such as this, where, of course, you can scalp, and swing moves to the upside, right? This is the daily time frame. You know what I mean? So when you see displacement like this, when you're seeing displacement like this, how do I know price isn't going to react off any of this lows here, and then this low here, right? A lot of you guys probably marking this as, demand zones and, rubbish like that. But you guys are failing to realize that price moves in the higher time frame scale, right? Price moves with the higher time frame. If the banks are trading, with trillions of dollars per day, they're not looking at, a 1 minute, 1 second change of character and all that. They're not, right? They're going to try positioning their positions, right, in moves like this, where it takes a couple days, couple weeks, couple months to, continue with the given direction. So the importance of, time frame is very crucial. This will allow you guys to not get stopped out and just be a feather in the market. And you guys will actually know when to, play defense and when to attack. These are the time frames I use, right? All the way from the 10 seconds to the 4 months, right? Anything above the 4 months, I kind of feel like it's a bit, bit ridiculous, right? It's going to confuse yourself. 4 months is good. If 4 months does confuse you guys, then stick with the monthly, right? Monthly is fine too. But the premise of, utilizing these, higher time frame candlesticks is we get to position ourselves in their wick, right? Their profile. Every candle, so if we're looking at these daily candles, right? Every candle, every bearish candle will have an opening price, which will be here, make the high, which will mitigate some sort of PD ray, and then continue the displacement lower, right? So open, create the high, displace lower, make the low, and then close, right? Every bearish candle follows that sequence, right? So if we know that's how a bearish candle is going to print, right? Then if we can, position ourselves in a bearish candle in a higher time frame, weekly, monthly, 4 months, then we know we're on the right side of the market and we could take complete, advantage of that, right? So we know what price action to look for and what to avoid. Very, very interesting. Now, what is this line? How did I come up to, the conclusion of this line? It's very, very simple. It's a 4-month fair value gap right here. In a bullish market, if we have a fair value gap, and if we have a higher time frame drawn liquidity, so let's say that's already been taken out, so that could be the retracement to that 4 months. Let's say, for example's sake, this is our drawn liquidity, right? If we want to continue higher in this given direction in the 4 months time frame, we'll most likely tap into this 4 months fair value gap and then continue higher, right? Or it will give us some sort of retracement to at least, get us some trades. Again, it doesn't need to reach up there. This is a 4 months. This will take, the next couple of years, right? That's fine, cool. But, we have the bias of, right, since price is bearish, since price has swept this previous 4 months high, and now we've got a bearish bias until the 4 months fair value gap, then you could position your trades like that too. So now, go on the monthly. What's a monthly saying, right? And you'll see in the monthly, as this is happening, you have a monthly range here, and there is no fair value gaps here. So you have an IDR, right? You guys need to understand the importance of fair value gaps and the lack of fair value gaps in specific price action. So now in the monthly, we know price is going to be bearish to at least this swing low here, which is the 4 months fair value gap that we just looked at earlier, right? Very, very straightforward, very, very basic. How simple is that? Just from using the high time frame, we've got rid of every other, deciding factor of, can price, retrace from here and reverse and all that, right? So if you guys are stuck on the 4 hour, all these lows, all this liquidity may look appealing for you guys. You might have this as trend on liquidity, and you have the demand zone that we spoke about earlier, or you're trying to long off every single demand zone here like an absolute bomb clot, right? So you guys aren't taking this seriously, and the main reason why you guys aren't taking it seriously is because you think 4 hours is enough. You think 4 hours is enough where you can comfortably have the executions and be confident in your analysis. But you have to understand there's people and there's banks out here, they're not even looking at the 4 hours. They're using the weekly, the monthly, and all that. They've got trillions of dollars of positions that need to be fulfilled. They're not going to be fulfilled in the 1 minute, right? So now, just from the monthly, we know this high here is a range high. Okay, if we want to go to that monthly fair value gap, we are going to sweep the range high. So that means when we do sweep the range high, we should be, seeing instant bearish price action. All right. So if we go on the weekly, what does this look like? Weekly, it's a weekly IDR. IDR gets swept. Our bullish fair value gaps are failing to hold. Why? Because we have a higher time frame, as I said earlier. Okay. If you guys paid attention, our higher time frame. So the higher the time frame, the stronger the magnet. All right. So if this weekly isn't holding, why isn't it holding? It's because we have the 4 months right below us. All right. Very, very interesting. Okay. And then, when you're analyzing price like this and you see the weekly failing, and then you have these daily fair value gaps that are, pushing price lower, right? You can be very, very smart and partial how you want. You could be aggressive. You could be, a bit more passive with your partials because, you know where the exit is, right? So let's say you have a position here, your first partial might be 2, 3R, 4R, and then you're letting it run to all the way down here, right? And you're not going to be looking for longs here, really. You might scalp some, you might counter trade, but you're not really looking for longs until this low has been taken out. Whereas the other people that aren't, understanding how the markets move, they're looking at this as break of structures, right? Look how beautiful this break of structure is. And then, this demand zone here, or this mitigated demand zone, you know what I mean? And now what's going to happen is when price does reach here, right, and then we get our reversal, so we've already swept our idea here. So we've had our total sweep, our stop hunts, right, liquidity sweep into our higher time frame PD array, right? Now people are still looking at this as, supply zones, and they're shorting that. Does that make sense? Right? So they're actually behind, they're lagging in the market. It's so funny when you start, seeing price like this, they're marking all these demands, supply zones here, right, as break of structure inducement, this and this, and they're just getting wrecked, right? Because they're failing to realize what the real move is and where price is going to go. Okay, so it's very important you start utilizing the higher time frame. A lot of you guys need to, get rid of the 4 hour as your higher time frame and start, using the daily, the weekly, the monthly, the 4 months, whatever it may be. All right. So, once you do have, price aligned here, so you have this here. So, okay. So what I'm going to do here, and I go very, very in depth with profiles, so like candlesticks, in terms of, open, high, low, close, AMD, etc. in my Discord. So if you are interested, join it. And I do stress about, fair value gaps and the importance of that. My whole system is based around fair value gaps and profiles. All right. So I feel like I've got a bit of expertise in this field. You know what I mean? So we can divide this into, every vertical line is a opening price on the 4 months, right? So now if we're going on the weekly, so what we have here is on the weekly, we have opening price, make the high. So this weekly chart here, we're looking at weekly order flow within the four months profile. Hopefully that made sense, right? So this is, opening price in the 4 months, and this is the closing price. So we had, opening price, create the high, displace lower, right? And then create the low here. Okay. So now if we're expecting, bullish price action here, opening price, create the low, which tapped into our PD array, and now we're expecting some sort of expansion higher, right? So now if we're expecting this high to be taken out, right, we're going to expect daily and weekly and monthly fair value gaps that are bullish to hold to take us to this area, okay? So this allows us with this 4 months candle to close, pretty bullish, maybe around there, right? But if we start getting bearish order flow, right, what are you going to have? You're going to have, your weekly fair value gaps marked as areas of, support to see bullish price action. And if those bullish fair value gaps here aren't holding, then we could just made the high on the 4 months candle. So opening price, create the high, displace lower, and then close, right? Very, very straightforward. But I'm not going to go too much into detail how if it's going to be bullish or bearish candle, right? I'm going to, respect my students and, keep it in my Discord, right? But the main premise of this video is to, showcase, start utilizing the high time frame, and this works in every asset, right? So, we'll go on the weekly on gold. So with gold, I spoke about this, and I've got evidence, which I'm sure you guys trust me, right? I've got evidence. I'll show you guys if I want to. But we spoke about how price on displace after mitigating this weekly fair value gap. Okay, and if we look at this on like the 1 hour, let's say, so that's all a weekly fair value gap. That's it, right? That's all it is, just weekly fair value gap. And then you have, the range sweep, and you have displacement, time and price, and other stuff that's in the Discord, which I am going to keep private. But, a lot of people are looking at this, they're looking at this as a change of character or market structure shift. And now, they're looking at this too short. Yeah, cool. It runs, you might get a break even. Cool. And, they're still looking at this as a break structure. Break structure there. They're trying to short it. They get wrecked, right? And now they're looking at this as like a unmitigated supply zone, inducement there, trying to short it, get wrecked, right? And they keep, trading this laggy and delayed price action because they're trading structure instead of order flow. All right. And that's the difference between, people that are trading with the market versus people that are trading the lagged market, because they need this, supply zone to cause some sort of reaction. So they go break even quickly because they're chasing 50R, you know what I mean? But the people that are trading order flow, they know these supply zones aren't real and they're not going to do anything. It's just liquidity that is going to be taken out, right? And you'll know that price is now in sync with the high time frame. Weekly fair value gap aligned with the monthly opening profile, sorry. So that's how the markets move. So let me really dissect that for you, okay? So it's a little piece of, golden nugget for you guys. So weekly fair value gap, okay? Beautiful. And now if we go on the monthly, what do we have here? Bang, bang, and bang. So every vertical line is a monthly open or closing price. We go on the weekly. What do we see in the weekly? We have this, right? So opening price, accumulation candle here. Your indecisive candle will get swept in a bullish market and a bearish market if you know your draw on liquidity, if you know your order flow. Weekly fair value gap right there. Opening price, right? Must stuff around for a bit, whatever, cool. Opening price, create the low of the wick. Okay, create the low of the wick on the monthly candle right here with this weekly fair value gap. Then displacement occurs. Okay, so this here is the wick on the monthly candle. So opening price, okay, so opening price, right? Fuck around for, however long. Create the low with a higher time frame PD array, expansion higher. Look at that on the monthly candle. Open, low, high, close. Right? So you guys are missing out if you guys aren't, looking at the markets like this. And what's going to happen? There's always going to be a fair value gap that's going to, give you an entry. All right? I don't want to talk too much about, too much source, but just know you guys are missing out. You guys, be careful who you listen to, Be careful about supply and demand. Be careful about breaker structures and all that, right? This is how the real markets move. And you guys need to start realizing this before it's too late. All right, thank you.